those who've attended here today to attend the When to Hire or Fire an Advisor. Today, I'm Myles Clements. This is Ted Bovard, the CEO. Fort Pitt Capital Group. So we are an in-house investment firm and fiduciaries. We specialize in financial planning and investment management. We are a boutique firm, meaning we don't want you to feel like a number. So when you work with us, you work with a dedicated team, an advisor and administrative staff member that's here to help you in all the capacities available, so that you never have to feel like you're going on your journey alone. For our webinars, truly the reason we put these on is that we want to consider ourselves life advisors. We are here to provide education, make sure that anyone that needs help or resources has those available. So if you have questions throughout today's discussion, please feel free to ask them. But that's really a big reason why we put these on. And we did receive a plethora of questions from those that registered for today, which we'll be going over with the group. So as I mentioned, my name is Myles Clements. I'm a certified financial planner here at Fort Pitt Capital. And my approach to working with clients and prospects is to really base everything around a plan. And that's exactly how Fort Pitt and myself work. I always give the example, imagine trying to go on a trip without GPS or a map. Chances are you're going to get lost. And so when we're engaging with individuals and families, that's our start. And that's my approach to planning. When I'm not at work, what keeps me busy is my 4-year-old son, who embodies the Tasmanian devil at times. Ted has heard some of those stories. And my 6-month-old daughter and our dog, Shiloh.
And I'm Ted Bovard. I have the title of CEO, but I've been an advisor for almost 40 years. I'm one of the founding partners at Fort Pitt Capital Group. And as Myles said, we like to start our approach with building that foundation for our clients, looking at what makes the most sense in how to best achieve their goals and do it in a way where they can sleep at night. So outside of work, do I do anything outside of work? Oh, no, I do. I have my 3 daughters are grown and out of the house for the most part, and my son is 9.5, and we, besides chasing our crazy dog around, we basically chase them around. So that's what we do outside of the work environment.
And before we get too far into the webinar here today, we do just want to let everybody know that there is a way to interact through this webinar. So if you're looking at your screen, there's a tap, at the very bottom corner, there's a tap on your screen to ask a question or get a handout button. So if you have a question throughout the presentation, please feel free, ask it. We are going to do a Q&A at the end today to address those questions that are either provided during the webinar or provided in advance.
Thank you for all the questions. So there's been a lot of questions ahead of time, which helps us just in framing what the webinar looks like, what questions to answer in part of our presentation so that we can cover as many of those things as you have sent out. So really appreciate all the questions ahead of time.
And to lay out the agenda for our talk today, obviously the big one's going to be why you're here. I think trying to find a financial advisor or make the decision about an existing advisor that you may have is a very intimate and personal decision to make. And I always give the example, it's kind of like having someone as your primary care doctor, right? You want to make sure that person really understands who you are, what your goals and objectives are, and how best to administer care to you. In addition to kind of addressing some of those questions that we've got, the power of an advisor. It's one I know, Ted, you get and I get, and a lot of the folks here get, is what is the either tangible or intangible benefit of having an advisor involved in your situation? And then once we kind of dive into that, we'll discuss the benefits beyond just the obvious. Those are those things that I don't think enough people think about, but it's oftentimes come up during initial meetings with individuals and families that really, I think, highlights the value of having an advisor in your corner.
Well, I think one of the things too on that is that beyond the obvious, everyone thinks it's just a financial plan or investments, when a lot of times it's, hey, should I finance this car? Should we buy the car? What should we do? When do we start the 529? All these other things that are going to come out that are all questions where we basically fit in wherever we can help or redirect if we don't have the answer to send you to the right place so that you end up getting the best advice for your situation.
We thought it would be a really good idea to first start in looking at the timeline or the life cycle of what every individual and family is going to go through. And even in this, I think there are a lot of misconceptions around when an advisor is needed or not needed. Think of it this way. If you were a young adult, fresh out of high school or college or trade school, you're just starting your working career. I remember those times. There were a lot of questions that I had as I was going through the initial journey, to becoming an advisor, and didn't always have somebody in my corner to help me evaluate and really understand the impact of decisions, whether it was to save for retirement or save for a house or buy the car, as you had mentioned, Ted. And then as you go through your life, you're going to hit things like you're going to find a partner, possibly have a family, then you're going to retire or maybe consider retiring. Eventually you'll enter the retirement phase, and then that's a whole different type of planning and advice that will be needed. And Ted, for you, if you can give the group here just some color, around the type of questions or ways you think advisors can help elevate people as they go through this archetype of life.
Right. Well, Myles, I think one of the things that's fascinating is so many people think that it's these last two pieces, the pre-retirement and retirement, is where they need an advisor. And that's where I think a lot of times they miss the boat, because you've got so many years to compound your dollars early on as young adults or young couples. And as you're formulating both your savings plan and your investment plan, whether it's 401k, it's making sure that everything's moving in the right direction. And literally that from 25 to 45, that 20-year period, you can miss a tremendous amount of compounding by either not saving, not thinking about it, not having a game plan, or not having anyone to say, hey, no, don't put this money here, put the money here. It'll do better for you. And all of a sudden it's 45 and you start to go, oh, we need to think about retirement. I need to get worried about these other things. Where the power of compounding, you've missed literally a chance to double your money, a couple times in there before you even get to that point. And it gives folks a huge head start. For us, so many times we end up working with the parents, and when we actually talk about this with them, they say, oh my goodness, will you talk to our kids? And then we get that start. And we've seen the power of how you can really have financial flexibility much earlier in life by just having that counsel in your mid to late 20s, in your early 30s, so that you're much more prepared later on. Again, obviously the pre-retirement and retirement make a lot of sense, just to make sure that you're on track and you're getting where you want to go and you have the money you want to spend. But literally at every point of this, having someone there to help can really save you a lot of time and save you making a lot of mistakes. Because you can make some critical mistakes early on and either say, oh, the stock market's not for me because of one mistake that was made, or having received bad advice, and it keeps you from making a good decision for maybe 5, 10, or 15 years.
Absolutely.
That's a lot of time.
It's a lot of time. One of the things I try to help and guide a lot of clients on is really trying to point out or bring to light areas of their life in the future they may not be thinking about today. And you look back to the young adults, early to late 20s or early 30s that are maybe considering, we're going to have to buy a house, or eventually maybe start to have kids. Well, if you're not doing those things right now, is this a prime opportunity to start to put money away?
Right.
Knowing that there may come a time where cash flow gets a little bit tight. Someone with 2 kids, and my 4-year-old likes to break many things. I think it's imperative that you're able to have someone that's working alongside you to help point out some of the either misconceptions, where the potholes or speed bumps are, so that you can avoid them. And by avoiding them and doing the savings early, it completely will change the trajectory of not just your life, but your family's life.
Having that advisor come alongside you basically through those life changes. In your case, a replacement fund.
Yeah,
yes, for the things that are broken.
Yes.
But whatever it is, it's be specific about your goals and objectives.
Yes, absolutely. And to that point, finding the right fit for an advisor, and this was a question that we got a ton of from those that registered, making sure that your advisor understands the personal connection, knows who you are, who your family is, not just about monetary numbers, but truly understands you on a very personal level. I can't tell you how many people I've met with in the past that have either had a misconception about an advisor where all they want to talk about is my money, or they have an advisor and that's only thing that's ever addressed in the conversation. And there's never been a moment to step back and say, we're going to be working together for a very long time. We really want to make sure you understand who I am, who my family is, who you are, who your family is, and building that trusted relationship. And I know, Ted, for you, that's been a paramount for how you interact with clients just over the years.
Right. Well, that relationship is what's going to drive all of it. So if you can't, if I can't understand what's, Mr. and Mrs. Investor want to do, if I can't understand what's most important to them, how do we build a plan around that? So it means you're asking those questions. Sometimes you're asking the tough questions. Sometimes you're in the tough conversations because you've got to get through that to say, look, we're in this together. It's not like an I told you so situation if you don't follow our advice. We're a team, so the team loses. So that doesn't really work. You've got to see that we care about what you want to do, but we've got to do that by asking a lot of questions, and that takes time. It takes vulnerability on both sides to build, because ultimately you're trying to get to that relationship where you go, oh, okay, hey, we've got this decision coming up. I got to call Myles and find out what's going on. Ted, what do you think about, is this the right thing? Or, hey, my daughter, where they're getting married and they're trying to figure out how to best spend or do how can we help build that out? And that just, I think, furthers that relationship.
Absolutely. I recently had a meeting. They've been clients of mine now for maybe 18 months. And we got on a video call because they live, a couple of states away. And I could tell something was off during the initial meeting. And I took a step back, put the agenda aside, put the numbers, essentially under the keyboard, and just asked how they were doing. What's going on? I could tell something was a little bit off. And going through that conversation with them, come to find they just had some really major financial questions and concerns that were causing a lot of stress within that. And if I wouldn't have asked the question, I don't actually know if they would have brought it up to me.
Right.
But to your point, it takes time to build that relationship. And honestly, it's on the job of the advisor to really help identify when those things are popping up and make sure we spend the time to do the deep dive. Because if you just glaze over it, what may have seemed like nothing 10 years later could have really been something.
Sure.
You
have to ask the tough questions. You have to be willing to ask the tough questions. And that's in building that relationship, because it's the only way you're going to build the trust, for sure.
Absolutely. Once you've had that personal connection with an advisor, you've got that trusted partner, that's when you really want to spend time to understand, how does this advisor work? What is their approach? How are they going to provide me with advice? And that is an answer to a question that's going to be different for everyone. One of the questions I ask folks, and it's more for me to understand how I have to cater my advice to them, is when we meet, are you the type of person that's going to want to know what time it is when we're looking at a watch? Or are you going to want to know how the watch is made? And there is no wrong answer to that. But all of us are different. We all have a different approach to life. We all think differently. And if I'm not able to bring advice and solutions to you based on your own goals and objectives, that's easy for you to understand. That's where I think a lot of tension can build. And yet again, a lot of missed opportunities can present themselves. Right. And then also, we don't spend the time on actually building out those goals and objectives.
Yeah. Well, it's you've got to have that fit. Like you've got to feel comfortable. They've got to feel comfortable. You've got to build that. Again, it's back to that relationship. Because if you're feeling that you have trouble either talking to your advisor, or that you keep asking questions and you don't really get answers, or any of those things come into that personality fit, you're going to have trouble reaching any of your goals. And it's got to be about your goals. It's got to be about how do we achieve in our family these financial goals? How do we tailor that to you? And then from an advisor standpoint, then we need to be accountable. So it's not just, hey, oh yeah, this is great, thanks. No, we've got to be accountable for the results. We've got to be accountable for the communication. We've got to make sure that there's a process there that both sides are comfortable moving forward with.
Absolutely. I one of the things that's always stood out to me, as part of being an advisor, is it's not just building a financial plan. It's also behavioral finance.
Yep.
That's a huge element of what we do. And you have to understand how the people you're engaging think and feel about their money, because historical preferences or life circumstances will dictate a lot of that. And we've had clients come to us who either never had an advisor or had one, and we can look at a plan and say the plan looks great, asset allocation looks in line,
Right.
but what's missing? And that's the piece that I think is probably the most important that gets overlooked.
Right.
Is that.
Right.
Absolutely. Another big part, in the modern era of money, it's just complicated. Money is more complicated today than I think it was probably 20 or 30 years ago. And I don't necessarily see a trend in that changing. And as a result of that, advisors have to step up and be proactive at solving problems. If we're always on our heel and you are bringing those issues to us, chances are we're missing a lot of things in your situation. And I'll go back to the medical example. If I have to go to the doctor for my annual physical and have to tell them what tests they have to run on me, usually that's a time I need to maybe evaluate.
That might be a red flag.
It might be a red flag.
That might be a red
Yeah,
flag.
that might be a red flag. Emmett would be very upset not to get his Hot Wheels. So yes, that's not ideal. So you have to have a proactive problem-solving approach when you're working with clients. You have to anticipate the challenges and the roadblocks. You have to think outside the box. It's not a cookie cutter model. We don't just say everybody's going to be a chocolate chip cookie. That's just not how life works. Every plan is different. Every need is different. Every advice or customization has to be different because that's just the world that we live in today.
Well, what's fascinating is, so when I started in this business, there was obviously a lot less information out there. We didn't have everything on the internet. They were building a lot of those things out. Financial publications were limited. Channels were not channels. You had programs, but they were still building out the CNBCs of the world. And what's fascinating is there's now more information available on money than ever before. And what that means is there's more confusion about all of it. So that's the part where we've got to actually take all that, synthesize it, and make it simple. So that's where the plan comes in, and work with an advisor who constantly uses language that you don't understand, terminology that you have no idea what it means, never defines anything to confuse the daylights out of you. That's not really a good problem-solving advisor. You've got to have someone who can actually take those things, break it down, make it simple, and say, hey, here's the game plan. Here are the key things we need to do next. Here's what we need to do next. There are going to be complications that come up, as you pointed out. There's always going to be those challenges, but you've got to figure out a way to take the challenges and make the solutions easy to implement. Otherwise, they're really not worthwhile.
Absolutely. And if the solution isn't easy to understand and digest, it then gets almost impossible to implement.
Correct.
So we did all the work, we built the relationship, We've got the plan, but then we delivered the advice and the solution and it didn't register. Now we're left with no outcome,
right?
Which is probably in a lot of cases the worst outcome.
Correct.
Right.
Correct.
So you've got to be able to simplify the solutions based on goals and objectives and being able to problem solve. Right. There's a few areas, that I think Ted and I both, we see as being overlooked by the financial services industry as a whole. If you see any commercial, you log on to CNBC, Yahoo Finance, any of these publications, everyone's talking about rate of return, how your investment's doing compared to the S&P 500 or the Magnificent Seven. And it's not to say those things are not important. But if I had to look back at all of the clients I've ever met, had the biggest impact on, or help them find an alternative to maybe an existing relationship with an advisor that they had, it was that I was able to understand their psychology of money, able to build out and provide them with lifestyle financial planning, which is not the same as I'm going to do a projection on your asset growth. That's very different. Lifestyle financial planning is saying that, and it's having an understanding about life that it doesn't always work out the way you planned it to. So you have to be able to shift and change recommendations, advice, meetings frequencies. I've had some that have lived in Pennsylvania and now moved to Florida.
Right.
Life is going to change.
Flexibility
is critical.
Right.
And then it's the intergenerational wealth planning. If you look at the stats that are out there today, the generations to come are most likely going to be in a worse spot financially than generations of the past. And so how do you help the generations of the now prep the future generation and ensure that the same, not only just money, but the values, which is the critical element.
Right.
You can have all the money in the world, but if you don't have the right values and you don't pass those values along with your money, we've both seen it.
Yeah.
It doesn't end well.
Right.
So you've got to have an advisor that is going to be here for the long haul. Help the same values, the way that you thought and felt about your wealth, pass to your kids and possibly their kids, or to whatever charities of choice that you have. It's not just about, well, what was my rate of return last year relative to this benchmark?
Right. Right. Well, and that intergenerational, that transgenerational passing of wealth is going to happen. And so the key is you want to pass, as you said, it's going to be tougher going forward. So you want to pass as much of that as you can, tax-free, all the other ways, and set up your children for success or your grandchildren for success. And it's with those values and the same, habits, which, let's admit, are difficult in, the current couple of generations because they've not had to struggle. And so if the struggle comes in, this to help and can provide a tremendous backstop for them that can really help.
Absolutely. I know that when we meet with clients or their kids, that's from the get-go, that's how we approach the advice and planning for them.
Right.
Of when you're with Fort Pitt, your whole family's with Fort Pitt. When we're going to think about planning for you, it will be customized to your goals and objectives. But we understand that this is a multi-generational family type of planning approach. And the amount of stress and burden that I see vanish from people when we go through this process with them, it's profound. Because I remember at one point, for my wife and I, our plan was get married at 30, you have the house, then you have kids, and life happened. Yeah. And some circumstances changed health-wise, and the doctor said, well, Myles, you're 25, and if you want to have kids, it has to happen now, or it'll be never. So my financial planning brain broke for a few minutes, and then I looked at my now wife and said, well, we're going to start our family now. I didn't have anybody but myself at that point in time to go through that process. But Ted and I now have met with clients whose kids are going through financial changes and challenges, and we're here to help and guide them to make sure that when they get to where their parents are at, they have the same values. They had the right success that they were meant to. That is, like I said, in my opinion, if you look beyond the numbers, those are the three pillars that I think more people really ought to focus on. And it's not to say that rate of return is not important. It is. But that's the backdrop of these three items.
Right. Well, and as we've talked about, that all now begins with where you're going here, and that's building the roadmap. Whether it's the financial house, however you want to describe, whatever works best for you on that analogy, but it's building out, that foundation, and that the plan is that part of that foundation.
Yeah, and I give the example for people that we meet with. Your plan is a living, breathing document. It will change and morph over time, and that is normal and it's natural. But every time we get I just had one recently, they got a job offer, had to reevaluate a few moving elements in their picture because it's going to require a move, a pretty big one, to actually across the country. So what do? We sat down, we re-engineered the plan. We said, okay, here's what we thought cash flow was going to be. Well, that's going to change because you're moving to California. It's an expensive state to live in. Now you've got state income tax considerations that are much, much more substantial than they are here in Pennsylvania. And so being able to put all of this on paper visually, they were able to digest it and understand it, because the concern was this might actually be worse than we think it will be, Myles. We need clarity here.
Right.
Provide the clarity, stress and anxiety go away.
Well, when you worry, it's always worse. So if you got the worries and because you're looking for answers, it always seems worse because your mind, the psychology, is naturally going to take you there. So our job is to take that worry away, or as much of that worry as you can, and say, look, no, here's all this worry. This is how we navigate this.
And we've had a couple clients in the last, probably 18 to 24 months that have gotten, I won't say pushed to retirement, but
Right.
It's here's your 4-day notice of
Right.
the transitional period.
Yes.
And
you got to make a lot of big decisions right now.
A lot of big decisions, because now we're looking at, okay, well, I've got retirement accounts there. That wasn't supposed to happen for 4 more years. It's happening now.
Right.
I didn't evaluate a different opportunity in the interim.
Right.
And what I've seen happen, I know you as well, retirement was pretty close. You could see it.
Right.
And then you go, hey, Ted, can I retire now? But we just I've been doing this for like 3 weeks. And it's amazing how that settles in, and everyone's like, I could do that.
Yeah.
Because I think we both have those that I'll work forever. and you give them 3 weeks of nothing to stress about, and that's a very quick,
Changes their mindset pretty quickly.
very quickly.
Well, sometimes the family dynamics change too, whether it's grandkids, whether it's helping out actually a parent of theirs, so or several parents, depending on those things. So it's actually having that flexibility. But yeah, having the look in their eyes when they've been given 4 days to a week to make decisions on retirement, and even though they've been thinking about it, we've been planning for it a long time. We were still thinking we were 3 or 5 years out. You know, that flexibility of saying, hey, we've got the foundation built. So, okay, so we're going to tweak a little bit of, we're going to change out the handles in the kitchen. We're going to upgrade the bathroom. The foundation's solid. So those other pieces of the house are just part of the natural part of planning and living.
Well, and human psychology, it's very hard for us when we are hit with a sudden adjustment that we had obviously considered for a long period of time, but now it's going to be a reality. That what I don't forget what they call it, sets in, and you start to panic a little bit.
Right.
And we have seen people that we wish they would have called us a year early.
Right.
And they did things, and you ask them, well, walk me through your thought process here. And the number one I usually get if there was a mistake made was, I panicked and didn't know what to do.
Right. And I thought this was the lesser of evils.
Yes.
In the short term, that this was my best option short term, without seeing, hey, this is a much longer game. We've got a much longer period of time that this may have cost you a year or two worth of cash flow.
Yeah.
And they don't think about it in terms of, like, we look at that in retirement cash flow. You want to be careful not to take a year or two off the table just by thinking you're doing the right, safe thing.
You need experts.
Right.
You need the analysis. You will need the plan. To give one more story, I had a married couple. Husband finally retired last year. Thought he would work another 5 years. Truly, we built a plan, and it was you could have retired last year. To be honest, you could have retired a few years ago.
Right.
And as soon as I said that, his wife, she jumps in and says, "We're going on vacations."
Well, and sometimes that's a good transition into retirement.
Yeah.
If you're not, ready.
Yeah. And part of
Mentally.
this is that joint planning, because if you're looking at a couple, they may have different goals and objectives. How do we as planners step in here and put all of these goals and objectives, whether they be aligned or not aligned, on paper, so we can get an action plan
and balance it out.
Balance
It's
it
got
out.
to be balanced out for both of them so that they can both feel like that the plan is working for them.
Absolutely. We just talked about this the other day, strategies for success. And there were a lot of questions actually, about what we're going to talk about here, which was how do I evaluate, the success of my advisor, and how do I then evaluate whether my advisor is actually doing what's in my best interest? Are they following up with me, reasonably? What does that relationship, ought to look like versus what it looks like today? And this is on the backdrop of having gone through the financial plan. And this is the most critical element of the relationship. Again, regular reviews and adjustments. We are not expecting our clients to come to us. We have to come to them. That is the obligation as advisors. We are here to make you aware of what's happening with your money, make sure that you're heading on the right track. There's a reason why you've hired someone like us, because you may not either want to do it or have the expertise to do it. And if you're meeting with your advisor once every 4 years, typically there's probably going to be some things that pop up that probably missed opportunities.
Yeah. Well, it's tough too, because everyone sets that expectation. So there are folks who don't want to meet every year. There are folks who want to meet 5 times a year, and you figure out what makes the most sense to keep them on track. Because one of the things as we go through, the next couple of slides where we talk about the process, we talk about the planning and the way we do that, what's critical is you can build the greatest plan in the world. And if we don't keep you on track for that plan, your odds of success are pretty slim. And people like say, oh, no, well, you guys, what you do is you build the plan and pick the investments and set everything in place, and that's the most important thing you do. Like, no, it's an important thing that we do. But what's most important is what do we do the day after that, when the markets drop 5%, or you have a life crisis that requires a whole shift in things. It's how do we keep you on track for success? Because that's the hardest part, because there are times when the markets are down 20% and you're going to think we should change strategy. There are times when the markets are up 20% and you're going to say, this is the greatest thing, we shouldn't change a thing. And sometimes the exact opposite in both situations is the truth. So ours is to give you that advice that says, no, this is the right thing to do. You may not want to hear it, but it is the right thing to do. It is in your best interest. And that's a tough one.
I know we both have found ourselves in those meetings where you've had a long-standing relationship with someone. You've worked with them for 10, 15 years.
Yep.
And you have to have that difficult conversation of, this might be what you want to do, but if I was just a yes man all the time,
Right.
How do we know that I'm doing right by you? If I see something, I must say something,
Right.
regardless of if you like it or not.
Yep.
And I found that in those moments, the advisors that can have those critical conversations build a lifelong relationship.
Well, we've also seen folks come to us after they've had an advisor who won't have those conversations, mostly in terms of like retirement cash flow. We're saying, look, you can't spend that much money. We've got to actually cut. This has got to change a different way,
Yeah.
Or you've got to structure the portfolio differently so that you have a better probability of not outlasting your money. And we see them after, in many cases, it's too late. And they're like, what do we have to be a lot more aggressive now in our mid 70s in order to have enough money to spend. We're like, no. This plan should have been set up when you were 45 and 50. Like that's not the alternative. The alternative is to have those conversations when that's happening and prepare people realistically with the right expectations of what you can spend and how, and what are the probabilities of success in that.
And often I see that pop up, as you mentioned, once someone has shifted into retirement, we now have time. We're not at work 8 to 10 hours a day, plus a
Right.
commute.
Right.
And it's part of the natural progression of a retiree. I like to say that there's 3 phases of that. There's the phase 1 is, I'm going to retire. My palms get a little sweaty.
Right.
I want to do this, but I'm nervous because I went from working and getting a paycheck to, I've got maybe Social Security and now my own money to spend.
Right.
Once you get comfortable with that, it doesn't happen for everybody, but for some, they go a little overboard because, yet again, they've got 8 hours, 9 hours a day.
Well, they got a lot of time.
A lot of time.
And
we'll have
time's
that.
not cheap.
And
Time's expensive.
And we'll sit on this, in a meeting with them, and we'll ask, how's cash flow? And they'll say, I actually need a couple extra, $100 or a couple $1,000 extra a month. And we'll have to say, wait a second, let's go back, help us understand where that's coming from.
Right.
And most of it is a function just of that first phase. You're getting used to this new lifestyle. We have that conversation, very thoughtful, back to bringing it in the plan to show them. Option 1, you continue this road. Option 2, we make some adjustments. You get very comfortable in phase 2 after we've had that conversation. And then there's usually phase 3, which is we know that Father Time waits for none of us.
Yep.
And we've got to have the other difficult conversation of, what are we going to do with what you've built?
Right.
Where does that go?
Where do things go? Because there's more here than we thought we'd have.
And
A great problem to have, but a problem to have.
And sometimes there's the family complexities that can.
Are there family complexities?
Yeah,
okay.
right, yeah.
Interesting. Not in our family, of course.
No, absolutely not. No. As soon as I come home, my son looks at me and asks me, where's this new Hot Wheel?
Exactly.
Not a, hi, Dad, I missed you all day. No, where's my new Hot Wheel? But that estate legacy planning conversation, I can promise you that will be a very challenging conversation to have, because you now have to think about the reality of someone not being here anymore.
Right. And it doesn't mean that your advisor is an estate attorney. It just means that you're versed in what to do, and you actually have either the ability to work with their estate attorney, with their account, with the other folks, so that you can help guide and navigate. You give them an extra set of questions, of ears to listen, and so that you can, again, always put them in the best position possible to keep them on track.
We wanted to highlight, the investment process. There were quite a few questions about, just investment performance. How do we think and feel about, creating an investment plan in the backdrop of a financial plan? And so typically, if you're building out a very thoughtful investment process for clients, we have to first understand what the investment objectives are. That's the first phase. How some advisors approach this element is different. Some of them will approach it and ask a question, how do you think and feel about risk? And I push back on that question quite a bit because it invokes an emotional response. And when you're managing assets and we're planning for the future and we're doing the type of planning that's goal-based and not risk tolerance based, it requires you to slow down and go back and understand and know how to plan for goals and objectives. Because I can ask you, to your point, markets are at all-time highs. How do you think about risk? I might ask 100 people and 90 of them say, we love it. It's great.
Yep.
We've made a lot of money the last 3 years.
Yep.
If I ask them that same question in 2022, how do you feel about risk? I don't like the market. I should have just been in cash the whole time. The system is rigged against us. Asking that question invokes that emotional response that I don't think gives any clarity, truly.
Well, and looking at that through the asset allocation and the investment structure on the next couple pieces, I mean, to your point, markets at an all-time high or low. Tell me what your time frame is. I mean, I came into this business in 1987. Markets were at an all-time high. Now, that was a long time ago, but the high then was around 2,500 on the Dow. How have we done? Oh, that's a lot of compounding. If you think about the structure of what investments must do to hedge inflation and to build upon that, you're going to see a lot of all-time highs in your lifetime because that's the growth you get, and that's the compounding of every company. People go to work to make things better. Companies do to grow their earnings, to grow their stock prices, but it's through their earnings and through those other pieces. So I hope for your entire next 60 years of life, you see a lot of highs, and you should, because that's the way that should compound in wealth. But it's understanding that, and understanding that the more time you have, that risk changes very differently than how you feel in any given year or any given moment.
And the element thereof, and I've seen this, I've had people in their 40s, early 50s, they have Roth IRA accounts. This is an account that you've been putting money in, you've already paid the taxes. When we're expecting the money to come out, it'll be tax-free on those distributions. They've got 40% in fixed income being bonds. And you'll say, well, you're telling me your retirement goal is 65 or 67. Why do we have so much for this long-term goal?
And particularly in an asset which may be the last thing you touch, if you touch it at all, because it may be the greatest thing to leave to your kids or grandkids. But it's, well, this is what I feel. This is my, no, let's talk about what this money is supposed to do for you so that it actually gets to the right allocation.
And I always think of it this way, if I go back to, I've got little kids, and my son will learn how to swim, this year as well. Our job as advisors is not to kick people in the deep end and say, well, we hope you make it through.
Right.
Our job is to slowly push you out of your comfort zone. But if we can't deliver the advice and recommendations thoughtfully, those conversations don't end well, because the person receiving it doesn't understand.
Well, knowing that we care about your, meeting your goals and objectives, we're not pushing you in the deep end because it's a personal hobby of ours. It's to get you in the right place so that you have the greatest probability of success.
Another question we had there was, the investment structure and investment selection, and that is it's a big question to dive into, and it requires, I think, a more personalized conversation, because everyone's needs, goals, and objectives are going to be different. But if you follow what we've built in the flow chart, when we start with the investment objectives, we help determine asset allocation, we look at investment structure, we look at the selection, and then there's that last element, which we talked about previously, the monitoring. If we're not monitoring the assets, if we're not meeting with you regularly or on a frequency that meets your expectations, how do we know the investments and allocation we've just created are still in line with goals and objectives? Because things in your life will change. You will have, your kids will be small, then they'll be grown, and then they'll come off the income statement. At least fingers crossed, that's the hope. That's the hope. I'm finding it doesn't work.
It doesn't work exactly like you think, but it is the hope. It is the hope that we all have. But one of the things I might just mention is we just did not that long ago a great webinar on investment structure and investment selection and kind of how we do the things here at Fort Pitt. And it's a much deeper dive. If anyone, I think through our website can check that out, because that may be a great reference there, rather than you and I tried to get into the weeds on.
Yeah, absolutely.
We have other people to spend a lot of time with. So
once, and we wanted to kind of show the investment process just as an integral part of becoming a client. And
Well, this was a question we got too.
Yeah.
This was a popular question on like, well, how does this work? How do you guys do things?
Yeah, our process is, I think it's very straightforward. It provides clarity. It sets the right expectations from day one of starting the engagement.
Right.
And it gives reasonable timelines of when you'll receive documents, what the follow-up process will look like. And so let's just assume you sat down with Ted and I, first appointment. And that first appointment, we're going to spend a good deal of time on goals and objectives, also understanding who you are, the things we've already talked about, emotions,
Right.
behavioral psychology, lifestyle, financial planning.
We have questionnaires that go out ahead of this. I mean, so this is a big information sharing meeting.
Yes, and it's so that when we get together, and I have to back up a little bit, we send in questionnaires and request a bunch of data in advance. So when we get together, we're not sitting there flipping through pages upon pages of data. We've already done that. So we have a snapshot of what you look like today. Now we want to understand where it is you want to be,
right,
and how you will think and feel, and how we need to cater our recommendations to what will best suit you.
Right.
Once we've gone through that process, turnaround time's usually 2 to 3 weeks. Once we've done that first appointment,
right,
and we've gathered all the data, we'll write the investment plan recommendations. Right. We'll then mail that out to you, give you about a week or so to read through it, make sure you understand what's happening. We'll schedule then a follow-up call, or usually another in-person. And the whole purpose of that meeting is to dive into questions, because you're going to have them. And if you can tell, this is a very thoughtful process. This is not we sit for an hour, here's where you sign, and we move on. Because this is in a lot of events, is going to be either your life savings, or we're just starting to work together because you're starting to build your own wealth. And it's got to be this way. If it's a rushed process, it'll be a rushed job. And as my contractor buddies say in their business, if you measure twice, you only need to cut once. Versus we're going to do guesstimation. Guesstimation usually doesn't work very well in my experience.
In any industry.
In any industry. We also had some really good questions from folks about what should we be asking a financial advisor. As I said, Ted and I, we're in meetings a lot. So we meet with a lot of new people that ask us questions all the time. When you're meeting with financial advisors, you want to understand, what does the compensation structure look like? How is that advisor receiving pay for the services provided?
Right. And typically there are 3 ways. So it's either it's fees, it's commissions, or it's a combination of the 2 of them. This is not a difficult question. So if you're asking an advisor how they get paid or how their fees are structured, and they start to hem and haw and start to kind of, well, there's red flag number 1, 2, and 3 probably that you need to. Listen, we're not a nonprofit organization. We get paid for what we do. We try to do that fairly, and we can communicate what that looks like, both when you get started and then as you keep going, because that's one of the things I think that for an accountability, it's not just how the fees are structured, but 4 years down the road. So hey, what's the total cost? Yeah, the performance has to be net of those things. That's critical, but you still need to know what you're paying. You need to be engaged in that.
And that's part of the plan that we put together. We provide that information. We let you see, okay, if you're already working with someone or been doing it yourself, here's what those costs were. If it were to come to Fort Pitt, have us be, part of the relationship, here's what it would look like. It's a very easy to digest document. It's 1 page.
Right.
There's nothing to hide here.
Right, but it's getting value for what you're paying.
Exactly.
That's the other thing. Don't get stuck on the fee as it's the only and albeit biggest question out there, because it's not. What value are you getting for what you're paying for?
Yeah, and I follow a lot of finance people just on LinkedIn and other places, and I get this one a lot of advisors and their fees are unnecessary. It also depends on what your needs are. That's the other element as well. If you're in a situation where you may not actually need an advisor, there's nothing wrong with that.
Right.
But if you actually need the help, sometimes you're better to actually maybe pay the cost
right.
for the right value that you're going to receive to get you where you need to be. Ethics. This is a big one. When you're managing someone's money, I always go back to your medical professional. If your medical professional can't do a good job right? Doesn't have the right ethics, the right standards, the right codes of conduct, the right processes in place, you'd have people dying in the waiting room. We can't have that. So you've got to have an ethical and moral approach to handling people's funds, which at Fort Pitt, we are fiduciaries. That word fiduciary, though, may mean something slightly different depending on what type of person you're interacting with, because not everybody is held to that fiduciary standard. Some are held to what's called a suitability standard, meaning we made investment recommendations that we thought were, so they were okay. They might work for you,
Right.
But they've got to be tailored to your specific goals and objectives. There can be no cookie cutting when we do this.
Well, and the second point on there is there are any complaints filed. These things you can easily look up either via FINRA or through the SEC, the state regulatory, depending on their size, and they will disclose all that. A lot of firms will give you that disclosure. It's called the ADV form. With us, it's part of our initial package so that you get all that information, because you should have it. I will guarantee that if you try to read through it, it is great for insomnia, but all the data is in there so you can see what's going on with that firm and do they meet that standard that they tell you they're meeting? Do they actually do it when they actually file all with these regulatory agencies?
And then service.
Yep.
Again, this is 60% of what we do is the service element. How are you hearing from us? How is our correspondence? The amount of people I speak to that have an advisor already that say, I send an email, I don't hear back in 3 or 4 days. At Fort Pitt, it's same day within an hour. If it's not me, Dana Nixon, who is my client service specialist, she's on every email. You will hear from somebody. Hey, Myles in a meeting right now. Do you have time for a call tomorrow? Or if it's urgent, can we do it at maybe 5 o'clock? However we need to make it work, because that's why we're sitting here. We're here to give you peace of mind. And if it's urgent, we've got to make it happen for you.
As we talked about earlier, like what's the frequency of sitting down or through video having reviews and going over the portfolio? There is no one size fits all. Some folks want to meet once a year. We want at least to try to do once a year because we want to make sure we're not missing anything. There are folks who want to meet a couple times a year, some that don't want to meet ever until there's something pops up. Those are usually more difficult for us because we feel like we're not in close enough contact. So we're going to constantly request more communication and more meetings than that. But you've got to figure out what that right pace is for you and your advisor in that relationship. Let me see, what are the other, do you outsource any of the decisions impacting the accounts? We actually do not. We do a lot of our stuff in-house. So that's a good question to ask, whether they use outside investment advisors or whether they do the work internally. So you kind of know where that's coming from and kind of how they're deriving at their investment decisions.
And to get just a little bit deeper on that, because you bring up a very interesting point, at Fort Pitt, I can walk right over to our investment team. We have a question. Hey, we have a client that has a very unique situation. We need to get someone on a call. We can all talk and everyone's on the same page. That is not the case at every institution. There might be in-house investment management, but how available is that team when they may be needed? What I found is that sometimes it's very hard to get them on calls. That's not how we operate at Fort Pitt. We are here to serve you and help you. And if there's something we need to bring chief investment officer in or one of our investment analysts in because there's a very specific question, instead of me trying to be all hats to everyone,
right,
we have the resources and the team available to make those conversations happen.
And let me jump to the last one because it kind of ties into that. On the investment committee, we have an investment policy committee here, but we also have an investment team. So they meet every day, like all the time. This is what they're paid to do. What we don't do here is we don't believe that our advisors, Myles and Ted, can actually manage our client relationships and their expectations and meet with them and be making all the investment decisions. We think those are two different sets of brains, maybe right and left brain on how people think. Some people are much more interested in the relationships with other people. Some people are much more analytical. Some folks are both, but it's trying to figure out from strength, where do we get the best results for our clients and be able to do both sides of that house, if you will. So we separate them out here because we think that it's different ways people think and that we get the best results for our folks.
Well said, Ted.
Thanks. I've been here a couple of years.
So now we're going to jump to the Q&A, portion of the webinar, and we already actually have one question here, which I've got to zoom in a little bit on the question box, but I will pull that up for everyone. So
I'm glad you know what you're looking
Yeah.
for here. That's great.
So the question we got is, we are considering making a change to another advisor. How do we make a fair comparison between a known advisor and someone new? How can we compare actual results with current advisor to what the prospective advisor proposes? This is actually a fantastic question because in a lot of instances, it can be multifaceted. So when we at Fort Pitt create an investment plan, a financial plan for someone, we build out our recommendations. What I usually like to do at that point is sometimes have an addendum to the plan that highlights what we call other planning considerations, because we give all the historical investment data, returns. You'll be able to see all of that to make the fair comparison, net of fees,
Right.
before, after. We'll go through all those details. But I oftentimes see a tremendous amount of opportunity in the additional planning consideration bucket. And what I mean by that is, are we not just building out a financial plan, but are we looking at creating a tax plan? Right? How do we understand how tax laws are likely to change, from now until 10 years from now? Because there's going to be a lot of changes that are going to happen. And sometimes if I can run the analysis, we can actually give you a dollar figure that says if we do X, Y, and Z, if we consider a Roth conversion, or if we consider actually maybe not saving in Roth because you're in a very high tax bracket in your peak earning years,
Right,
and doing a 401k pre-tax, it's going to save you $6,000 to maybe $5,000 a year in federal income taxes. We will clearly highlight that to show you. So now, not only do you have an investment plan with our thoughts, feelings, and emotions behind it, you've got fee comparisons, you've got all of our written recommendations, but now you've got this extra set of talking points that if you don't already have, I think kind of gives you the tail of the tape, as they say in boxing, of who landed what punch,
right,
but who dodged and who threw.
Right.
You can see everything for what it actually is.
Well, and that's the performance comparison is pretty easy, except for you're probably going to have one difficult thing, and that is not every investment advisor will give you performance. So, I mean, it's becoming much more a part of a lot of the plans baked in, particularly in the big houses, because they've had trouble because they have never given performance. So people are like, how have I done? They're like, oh, you've done pretty well. What's the number on that? There should be a number. If we manage an account for you, we have performance and we start to track that from the day we start managing the account. You should know that. We have to be accountable to you for that. So those are sometimes I would say some of the easier ones to compare. The hard part is the relationship, because starting any new relationship can be difficult because you don't know what you're going to get from the other person. You don't know what to expect. So if you're looking for another advisor, it's usually because something is missing.
Yeah.
And you know it's missing, or there's not communication, or there's some whatever that factor is. And I would say probably the first thing to do is either have the hard conversation with your existing advisor. If you like everything else that's going on there and you're comfortable with the advice, have the hard conversation. Just say, we're not meeting enough, or I don't feel like there's the right connect. See what the answers are. When you ask the tough questions about if you don't know what you're paying, if you don't know how your returns are, and you're not getting good answers, I'm telling you right out of the chute, you've got a problem. And I'm going to take one other quick tangent on this, because this is one of the ones that we've seen it a few times. Mike and I have seen it a bunch of times where I've got a friend. My friend's running the money. I'm like, oh, okay, well that's great. I mean, that's fantastic. And I mean, I'm happy to say that with a lot of the relationships that I have, they have become friends. But we didn't usually start out as friends. We started out with the client advisor relationship, but that gets sometimes lost because then they're no longer as accountable on returns or on fees or on things because it's your friend. And I've looked at a lot of those friend accounts over the years and said, well, your friend has performed at half of what we've done, and they're charging you twice what we're charging you. So is that a friend? I mean, maybe it's time to separate the friendship with the business relationship to make sure that you're getting the things you need. It's not all about performance. It's not all about fees, but those two are pretty important, particularly on the performance side. If you're getting half of what other people are getting with the same goals and objectives over a 10, 15, 20-year period, that's a lot of cash flow in your retirement that you are giving up over friendship. So sometimes you have to separate those two. You still have to, even with friends, you've got to hold them accountable.
We have another question. Is it possible to retain Fort Pitt Capital to manage only a portion of my portfolio? I know, Ted, we've both run into this,
Sure.
over time, and sometimes there's actually specific considerations. I have a plan through an employer that
Right.
says we can or cannot do X, Y, Z. It has to stay there.
Yep.
We don't say, well, we'll never meet with you then. Forget that.
Yeah.
That-
The short answer is absolutely. Yep, we can do it. We can do it wherever we can add value, wherever we can help you, that's where we want to help. All right.
Let me see if there's any more questions that have come
6,
in.
I know we had a bunch to begin with, but we covered them.
Oh, here we go. Question. What's the best way to test drive advisors? Are initial meetings fee-free and commitment-free? I love this question.
That's a great one.
So think of it this way. For us to demonstrate the value, I would say put our money where our mouth is.
Right.
Our process doesn't cost you anything to go through except your time. And in that process, you're going to hear both of us say a lot of things.
Yep.
We're going to deliver on X, Y, Z expectation. And then when we finally deliver your investment plan, you'll be able to see, did Myles and Ted, did they do what they said they were going to do? And that process, like I said, takes 2 to 3 weeks. You're going to hear from us as we're moving through that planning process. You're going to get to see actions and behaviors, systems and processes. That's how you test drive an advisor.
And that should be any advisor. So whether that's us or anyone else, you should have that same ability anywhere you go, so you have an idea. That's the idea of getting comfortable with them. Is going to take a meeting or two. It's going to take some communication to get that started.
I'm looking to see if we have any other in here.
Well, there's a question on whether we're proactive or reactive in our client. And I would say we're both. We're proactive in making sure we've got the meetings and things set up and having that monitoring ability. Reactive, yes, just because life will change. And as things change, we've got to be able to react in a positive way to your situation as it changes, so we can best continue to keep you on track and make any changes to the plan that are necessary.
And on the reactive piece, it's, hey, we had an opportunity to buy a house we never thought we would buy.
Yep.
This house in the corner went on the lot. We've always wanted it. Well, you can't wait 30 days to get on our calendar then. We need to meet as soon as humanly possible. Right. We have to make that happen. I've heard this, a lot of places will be, well, my schedule's booked for the whole week. I can't make that work. If you're bringing us in to provide the value and you need answers, if we tell you, it's going to take a week or two to get back to you on this thing, unfortunately, usually we're going to miss an opportunity or two. So maybe reactive initially, but then we are very quick to get response, very quick to get action items built and sent.
And one of the things that makes Fort Pitt different on this is that's why we usually have teams. So we've got multiple people who can actually help, so that if you catch somebody on vacation and it's a critical time for you to make a decision, there are other folks who both and that know you in your situation who can step in and help as fast as possible.
I believe that was the last of them. Excellent. Just to let everybody know, we do have some upcoming webinars. We have a tax conscious investing and planning webinar on March 7th. And then we have what happens to your money when you die on March 19th. Both of those will be at 12 p.m. Again, thank you all for the time, for joining into the webinar. This was fantastic. We love the questions that you had. If you need advice, if you have any follow-up questions, please feel free. My information is right there. Take the time. You can write it down, take a picture with your phone, send me an email, give me a call. We're here to help in any way that we can.
Yep. No, really appreciate the time and everyone the questions were fantastic. Hopefully this was helpful for you. And as Myles said, any way we can help, please do not hesitate to reach out to us. Love to work with you. Love to meet you. Oh, here's the legal. Thanks, everybody. Have a great day.
Have a great one.